Here we go. So thanks a lot for joining this Virtual Innovation Center webinar, focusing on investment readiness and understanding the investor processes. So just a very, very brief background as I'm letting more people in. This webinar is for 1 hour, so you will have presentation from experts from EY to go through this investment process, understanding the investors' interest and ways of assessing projects when they come through. Obviously, you're here because you have interest in the topic, whether very early stage life science company or on your growing journey and looking at further fundraising. So we are welcoming any interventions, questions that you may have. I apologize for the background noise that I have. I wasn't expecting such a crowd behind me. So that's a good thing, and I'm handing over to our speakers. But obviously, if you have any questions, just drop them in the chat box or unmute and just ask themselves. We really want this workshop to be as interactive as possible. As you heard when you joined, it is recorded. So obviously, I will circulate the recording afterward if you would like to share with any colleagues or would like to go back to any points that were done. So without further ado, I am handing it to Haman, who will be your host of presentation and talking through that. Thank you.
Good morning, everyone. Nice to meet you, and we look forward to talking to you today about a few topics, but on the general theme of are you investment ready and the key considerations that investors will often look at before they choose to make a fundraising investment into various companies, particularly within the venture space. So I am a director at EY. I am a corporate lawyer, specializing in M&A and venture capital work. I have a keen interest in this sector, life sciences, mainly because both my parents are doctors and I slightly failed them by not going into medicine. So this is my only way of appeasing them a little bit by spending some time in this space, in this sector. But I'm also joined by my colleagues, Sam Brown and Johnny, who I'll let them introduce themselves. Sam or Johnny.
Hi, good morning, everyone. I'm Sam Brown. I'm also a director in our transactions law team. Similar to Hammam, I spend a lot of time, or the majority of my time, working with rapidly scaling owner-managed businesses from very early stage, so quite nascent and nebulous concepts, a slide deck and an idea, through to multi-million-pound exits.
Thanks, Sam. So I'm Johnny. I'm an assistant director in our corporate finance M&A technology team. So working across the tech sector, including life sciences, helping, it tends to be founder-owned entrepreneurial businesses either raise capital, typically at a Series A or Series B stage, or eventually exit their business. So working on sell-side M&A transactions, either to strategic acquirers, consolidators, or to private equity.
Great, thank you both. And I will start. This isn't a sales pitch from any of us, so this is just a general teaching and hopefully an interactive session. So for anyone that does have any questions as we're going along, please do just let us know. But just to run through the agenda very quickly, we'll start off with some key considerations for investors that they will look at in evaluating potential investment. We'll compare and contrast the most common types of equity financing available, which is the most common thing that you see at a venture capital stage. We'll demystify some of the common terms. We'll run through some of the red flags that are often seen during fundraising diligence. We'll talk about interactions between a lead investor and follow-on investors, and a slide, if you'll just bear with us a couple of minutes, in terms of how we work with founders and how we can help them through their journey. So with that, we'll start with the first item on the agenda, and Johnny, I'll hand over to you.
Thanks, Hammam. So look, this is, I guess, how venture capitalists and potential investors will look and evaluate business. There's obviously lots of variation across sector and business model here, but I think if you take a step back and look at the VC investment model, primarily they're backing early stage companies, and so the team there is critically important. They're not just backing the business, they're backing the jockey as well. And actually there are lots of investment rounds that have happened with the team being the primary reason the VC has invested. So either they're a prior founder or they have deep technical knowledge in the area that they operate in. And you can raise funding without a proven business. And certainly at the kind of seed investment and Series A stage, actually building a credible team is critically important. The other point to make around venture capital is that compared to a private equity or a public market investor, they're looking to make a 10x or above return on their investments rather than 1 or 2x. And consequently, they need the market opportunity and the market size to be kind of big and attractive and fast growing in order for them to achieve that 10x investment. I think if you look across a portfolio of kind of a well-respected VC, lots of those portfolio businesses, you have the majority will exit either at 1 or 2x, 1 or 2 may also not make it. And actually where the venture capital investor makes all of their returns is on the Uber investment, is on that kind of 10x return, which basically turns their whole fund. So having an attractive market opportunity ahead of you is critically important as well. Customer traction here is really talking about product market fit. So I said at the start that team is a key component. As the business becomes more proven and you start to have customers that pay for your product or service, being able to demonstrate that there are willing buyers out there kind of proves the model and to some extent de-risks the VC investment round. And so being able to prove product market fit enables you to attract kind of more investment and on better terms because the risk for the investor is lower. And then market conditions is particularly topical at the moment, I think. So this is around kind of what's going on in the VC sector, what's going on in the wider market, and then how will that impact your business. So if I talk very quickly around what's going on in the global kind of macro environment, and then more specifically around venture capital, I think technology stocks globally have sold off quite heavily over the last 6 months. I operate mostly in the software sector, and in that sector, valuation multiples have dropped from kind of 10 times revenue to 5 times revenue. So valuations have been coming down over the last 6 months. The kind of other side of that coin is that actually there is still a lot of capital on the sidelines looking for high quality companies, high quality businesses to invest in. So particularly in the VC market, I think what I'm seeing is that some of the companies that 24 months ago were raising money at astronomical valuations, those funding rounds are harder to get away now than they were 2 years ago. But if you have a fantastic team, you're operating in an attractive market, and you've proven product market fit, there is still lots of kind of VCs and pools of capital out there looking to invest in high quality companies. And then the final point on this slide, competitive tension. So kind of my background is M&A and negotiating deals. Having a couple of term sheets from a few different investors is an incredibly powerful tool when you're negotiating the price at the end of a transaction and you're negotiating the terms. It allows you to kind of play people off against each other, and particularly in the venture capital world, it will allow you, as Sam and Hammam will come on to talk about, it will allow you to strip out some of the more kind of onerous terms that you might get in a term sheet. If you have competitive tension, you can leverage people against each other and make sure that you're doing a deal on terms that are right for you and your business. Whereas if you're only dealing with one investor, that kind of conversation is a little bit more tricky and you just have less leverage. Anything to add on that, Sam and Hammam?
No, nothing from me. And I think that macro point, I think in terms of kind of the downstream impacts that has into the venture space of what we're seeing in obviously the global markets, that we are then seeing that downstream impact into the private space and the venture capital space. So it is something to be aware of in terms of the valuations that you may have expected compared to what you might actually get now.
There's always a bit of a time lag there, isn't there, between public and private markets? But I think we're now I think the markets really peaked, public markets anyway, kind of back October, November time last year. So we're kind of 6 months into it now, and it feels like just kind of the combination of high inflation, rising interest rates means that money going into riskier assets, i.e. venture capital, the type of valuations we were seeing 24 months ago are just much harder to achieve now.
Yeah, definitely. Okay, we'll move on to the next topic then, which is the common forms of investment. And Sam will talk us through these.
Yeah, so across the next 2 slides, I'm going to briefly talk you through kind of the 4 key or most common types of investment you'll see in this space, from the venture and the growth space. We don't typically see kind of your additional debt, so we won't talk about that. I think that's relatively well understood in any event. So we'll focus on, firstly, equity. I would say that's probably the most common form of investment in the kind of early stage space. Angel or seed rounds will typically be subscribing for ordinary shares. Institutional rounds, once you're kind of dealing with kind of your professional investor, will typically kind of, they'll start off with some ordinary shares depending on kind of the stage of the company, but you begin to go into preferred equity, and I'll talk a little bit around across the next slide. And then when we're talking about demystifying some of the kind of terms specifically, what that means in terms of the return for the investor and the potential return for founders or employees on ultimate exits. Low notes, they're kind of a halfway house between equity and debt. It's typically used where a company is unable to raise debt or is willing to issue equity shares at a particular point in its development. They're most commonly in the form of convertible low notes, which effectively require an investor to lend money to the company, exchange for notes that can be convertible into equity at some point in the future. That debt is usually subject to some form of interest or potential repayment in the future, but the structure is really set up to enable a conversion at a future point, and that future point is typically the next funding round. And you'll often see people put in convertible low notes where they are unsure as to what the price of the next round will be. They need to move quickly to get capital into the business, so they put in some convertible debt via way of low notes. It allows the company to access some capital in a relatively short period of time. And on the next kind of equity funding round, the convertible loan holders convert into equity. And for kind of the additional risk that they've taken by lending the money in at an earlier stage, they're typically given a discount at the price of the following round. Advanced subscription agreements are often used as an alternative to loan notes, probably slightly less common. You'll see them referred to as safes in the US market. This is effectively you're given the capital up front for the subscription for shares, but there's no obligation to repay it. It will definitely convert into shares at a future point. And that future point is, again, either a next funding round or a maturity date. So maybe 2 to 3 years kind of after the initial kind of advancement of the capital, it will definitely convert into equity at a predetermined price. Whereas with a standard convertible low notes, on maturity, the obligation would be to repay the debt. And lastly, venture debt. You do see that in slightly more mature businesses once they've got some sort of kind of cash flow that they can, that the lender can leverage and kind of use to be sure that the interest will be paid down. Very often that venture debt is kind of accompanied with some form of equity kicker. So you'll be kind of repaying the interest on the debt and eventually have to repay the principal amount on the debt as well. But for the kind of additional risk that the venture debt provider is seen to be being taken as compared to standard lending, they would have some form of warrant instrument that would allow them to subscribe for shares at a kind of fixed price or to participate in future rounds. So Hannah, if you just want to flick on.
Yeah, and Simon, just before we move on to kind of transition across to equity finance, we've got a question from Laura, as why is equity the most common type of investment at early stage?
Why is it the most common? So it gives the investor obviously a percentage, kind of a stake in the company as the company grows. It comes with a number of additional rights that you wouldn't necessarily have with a convertible low note. So you would be able to kind of vote at kind of shareholder meetings. You have a share class that would, if the company kind of went through a kind of exit event, for example, you would be able to participate that. Worst case scenario, if the company tanked and became insolvent, you'd have a ability to recover pennies on the pound in a way that you wouldn't necessarily have with other instruments. But also it's more to do, the kind of the primary purpose is really to do with kind of sharing in the growth of the business in a way that you wouldn't necessarily do with debt. You can achieve to a degree with a convertible low note by way of the discount that's applied, but then that growth is then treated from a tax perspective as capital growth as well, which is obviously helpful.
Thank you for that.
I think on this slide it kind of covers quite a few of the points that I talked about on the previous one. So the equity investment, kind of distinguishing features here, obviously, is it the payment of capital into the business in kind of exchange for shares. You're not subject, as a company, you're not subject to kind of ongoing obligations to repay interest or to repay the debt at the end. We can talk about, there are certain types of shares that may have some coupon attached to them, preference shares, and ways of structuring investments at a later stage that you do see some investors use. It does require you to give up some of your ownership of your business, and therefore your control. Very often investors will want a board seat, for example. By virtue of their shareholding within the company, they will have a right to vote at shareholder meetings. You need to think carefully about how that governance structure works. The documentation for equity investments tends to be slightly more complex than other routes, and as a result takes a significantly longer amount of time. An investor will look far more closely at your business from a diligence perspective, but also focus more acutely on the terms of the legal documentation. And a lot of the points that are up for discussion and negotiation are far more protracted than they are in kind of convertible loan notes or advanced subscription agreements, where the terms are a little bit more cookie cutter, I would say, in terms of generally accepted market practices and kind of what we would expect under those instruments. Convertible loan notes, as we've talked about, they're interest bearing. The kind of principal amounts payable at a maturity date, unless a particular event happens in the intervening time in which they convert. It requires a lot less documentation than an equity investment. The process, kind of the time to implement convertible loan note, is therefore considerably shorter. There's less DD involved. Generally, it's, as I say, it's usually used as the method for getting capital into the business quite quickly and kind of kicking the can down the road in terms of valuation. And the other points we've here is noted there, that generally, whilst a convertible loan note's in place, the kind of restrictions or the controls or the kind of strings that are attached are slightly less than an equity investment. That you can note converts, it will take on kind of, it will be typically converted as part of a future equity fundraising round. So you'll be having those discussions around control at that point. But it allows you to, as I say, move quickly. The one thing to note here is actually that convertible loan notes do not qualify for SEIS or EIS. So that often is a reason to go for equity. It can be quite important for a particular type of investor, in a particular particular size of investment, that you would get SEIS or EIS treatment. So convertible loan notes aren't great for that.
And Sam, just in broad strokes, is it worth just kind of expanding on SEIS and EIS?
Now you're asking me tax questions, Sam.
High level broad strokes, yeah.
High level, it is effectively allows the investor to get quite a significant tax benefit from investing in a company of a certain size. The quid pro quo for that is that they are taking a form of equity that has a risk associated with it, and a convertible low note that has a coupon attached to it, as in a right to receive interest and ultimately a right to recover your principal amount, isn't seen as risky enough to benefit from that tax treatment. Whereas an equity investment where you are, handing over cash in exchange for shares that are worth something now, could be worth a considerable amount more, in the future, but could also be worth nothing, is deemed to be kind of, as I say, the bargain that's struck with the taxman in terms of your tax benefit. Then the company itself will have to meet certain qualifying criteria for, in terms of size, number of employees, not being controlled by another corporate entity. There's a list of them, and it's a little bit of a fiddly analysis, so I won't kind of overstep my bounds of my own knowledge in trying to explain it, but it is a quite common feature of kind of seed and angel rounds that you would want to get this called advanced assurance from HMRC that you are a qualifying company. The investor themselves need to be qualifying as well, and they've got caps on the amount of SDIS investments they can make within a tax year. So there is a little bit of analysis around that as well. Advanced subscription agreements, moving on to those, as I said, that it's an upfront investment. You are giving the cash now as the investor, not for shares on day one, but you will get some shares at some point in the future. It's just a question of what that value is, the value of those shares, the price that you paid for those shares. It can qualify for SE or SEIS or EIS, so it can be beneficial to do it that way. We see them again. We see them where capital is needed quite quickly and documentation is kept quite simple, so it can be quite quick to put in place. I think that's probably overrun on those points there.
Thank you for that, Sam. Johnny, and then do you want to talk about? We'll start obviously with some of the common terms that can be complex during a fundraising event. So one of the most common ones that you'll hear is around pre and post money. So is it worth just spending a couple of minutes just talking through what that means?
Yes, happy to. This is, as Hamam said, very common when you're raising a seed or Series A, and the distinction actually has quite a big importance to the founder dilution you then take on that round. So in this kind of worked example here, you've got an investor saying that the valuation is 1 million. In one scenario, kind of 1 million pre-money means that the kind of founders end up owning 80% of the business, 20% investors, and the total post-money valuation on a 250k investment is the 1.25 million. If the £1 million is, I guess, positioned as £1 million post-money, that's effectively saying that the founder equity there is worth 750k, and the new equity from the investor is 250k. That gets you to your £1 million post-money. So the impact is really on dilution. Where this also has a kind of knock-on secondary effect is when you're talking about employee share option pools. So the investors like early stage companies to have share option pools to make sure that the employees beyond the founder are appropriately incentivized, so that they are kind of aligned with the success of the business. If the investor is asking for a pre-money option pool, so an option pool prior to them investing, that is effectively additional dilution to the founders. Whereas if it's a post-money option pool, it would typically dilute the existing shareholders, the founders, and the new investor as well. So a bit of a difference in technology there. It does have quite a big impact on dilution on the transaction, and so understanding the difference between pre and post and in particular understanding whether the term sheet you receive is talking about a pre-money valuation or a post-money valuation is important.
Thanks, John. That's helpful. And then also within those term sheets, there are various other legal jargon is used around undiluted liquidation preferences. So I think it'd be helpful, kind of, Sam, if we can just talk through some of those as well.
Yeah, I'll talk through them. I think probably each of these bullet points I could bore you with kind of 10 to 15 minutes on each of the kind of intricacies of each of the terms. So I'll try and canter through them quite quickly. The first one here, undiluted versus fully diluted share capital, again, similar to the pre or post money under distinction, is quite important to be clear on. Fully diluted share capital, when investors talk about that factors in unissued but promised shares. So things like if you've agreed to grant you've given options to employees over X number of shares, those shares are factored into the overall percentage ownership. Similarly, if you had a convertible low note that was outstanding and yet convert, that would factor into your fully diluted share capital position as well. So when people talk about their percentage ownership or their voting control, it's important to be clear as to whether you're talking about issued shares, so shares that are actually in the hands of people, so the undiluted share capital, or the fully diluted position, and it can lead to quite different results. So just something to be clear about when you're kind of discussing that. Tranches, milestones, conditions, and commercial side agreements. I think particularly in the life sciences space, in the way in which products are developed or kind of treatments are developed, investments are often staged, so they will come in at particular points. You know, an overall investment round of 2 million across 4 tranches of, you know, 500,000 each, associated with particular milestones, whether that's kind of getting various approvals or getting through various testing stages. They would typically be set out in the subscription agreement, and kind of you need to be quite clear as to what the trigger points for those are and obligations to particularly that company side, that the kind of investors are obliged to fund on the reaching of certain milestones rather than it being at their option. You do often see companies asking for money to be put in escrow or kind of put in a sidecar account just to be sure that the cash is there. Liquidation preferences, I talked about this in the context of the distinction between early stage investors, kind of seed, pre-series A rounds, and kind of your more institutional rounds. Once you start to deal with kind of professional investors, they typically look for some form of downside protection, and there are other points on this list that kind of fall into that bucket. The primary one of those is some sort of liquidation preference. So they would subscribe typically for a different class of share to the existing ordinary shares. That class of share, in addition to giving them a number of other rights, would typically give them an entitlement to at least recover their invested capital on a winding up of the company or a guaranteed return on a sale and exit. It effectively allows them to take, you know, if they've invested $1 million, it allows them to take the first $1 million out of a winding up process, or on a sale, take the first $1 million of the sale proceeds. So in a scenario where they only held 20% of the business but had a £1 million kind of liquidation preference, and the business sold for 2 million, you know, actually they really should only be getting I won't do the math in my head, but they should get they're getting 50% of the proceeds in that scenario rather than the 20% that they would otherwise be entitled to. Convertible low notes and advanced subscription agreements, I think we've talked about them kind of in broad terms. There are specific terms within those 2 documents that are quite important. In terms of convertible low notes and the advanced subscription agreements, the kind of the triggers for conversion, it's usually the next funding round or an exit. There are often distinctions between the types of funding rounds as to whether or not there's an obligation to convert or not. So very often you have the concept of what's called a qualified financing or qualifying investment, which effectively is that so long as the investment round, the next investment round that happens meets certain criteria around size and kind of invested capital, that the convertible low note would automatically convert. If it's smaller than that, then there is the option to convert, but the investor shouldn't be obliged to convert. It's important from a company side perspective that they are obliged to automatically convert in the kind of qualified scenario. But from an investor, it's important that they wouldn't be obliged to convert in a scenario where the round was quite small or at a price that they weren't happy with, to avoid them having to convert at a price or into a size of round that they wouldn't be happy to. Most convertible low notes, as I said, will have a discount attached to them. That's the kind of incentive for the note holders or the people that are advancing the capital to invest ahead of a formal round. And the implications there are, and you see anything from kind of 10 to 20% discounts, is that if you go and raise additional capital at £10 a share and a 20% discount, the note holder only has to pay £8 per share. So they are sharing in some of the growth of the business between the time that they initially put in their loan amount and the time at which they convert. Valuation cap is something that's you often see and is put in place to protect the investor. It is effectively to say, look, I'm investing now. We don't know what the value of the business is, but I think we can all agree that it isn't above 10 million. So if your next funding round is like at 20 million, they are protected from kind of the outsized growth of the business across that intervening time, so that they get a number of shares that's commensurate to the time at which they invested and the growth across that period of time. If they didn't have the valuation cap and they just came in at a 20% discount, they would actually not be getting the full benefit of the kind of growth from the time that they lent the money in to the time they converted. Anti-dilution protections, this is kind of, again, you see usually paired along with liquidation preferences. This is an investor downside protection. It is effectively a method to protect the price paid per share for an investor. So in a scenario where an investor has paid £10 per share and a subsequent funding round is at £5 a share, they say, hang on a minute, you've gone out and I pay £10 for my one share, but you've given shares to other people for half the price. You need to make me whole, and to do that, you give me an extra share, so I get a free share. So therefore, I've paid £10, but I've actually got 2 shares, so it's a £5 per share price. That can have quite catastrophic dilutive impacts for founders on down rounds. So needs to be really carefully thought about when agreeing, and it can drive certain behaviors. I mean, obviously no one necessarily wants a down round in any event, but it can make the consequences of a down round quite disastrous. Reserve matters, these are typically a list of items. It kind of look a little bit like a laundry list in terms of length, that protects an investor. The investor would typically almost always be a minority investor in the business. They won't have day-to-day control of the business. They may have a director on the board that has visibility and a right to vote, but he won't necessarily be able to control the board. And as a shareholder, their percentage shareholding wouldn't be significant enough for them to prevent certain corporate actions being taken by the company necessarily. So the list of reserve matters are to protect them, or to give them a number of vetoes over specific items or actions that the company might take. And that can be from a kind of director day-to-day basis. For example, you can't hire a new senior employee with a salary over X amount. You can't deviate from the budget by blob out without prior approval. Or from a shareholder perspective, you can't agree to enter into a sale or issue new shares at a price that's lower. Preemption on both issue and transfer. You'll often, this is a right that, whilst it benefits or protects the investors, also protects the other shareholders. On, in essence, on any new issue of shares or transfer shares, there's typically some form of preemptive or right to participate in that issue or transfer. So as an existing shareholder on an new issue of shares, you have the opportunity to pay up and kind of protect your percentage ownership in the business going forward. And similarly, on a transfer, you effectively have the first right to kind of pro rata participate in any transfer. If that's then not taken up, in both cases, there's the opportunity for either the company or the transferor to issue or transfer the shares to a new party. And lastly, drag and tag rights. You'll see these in the majority of documents. It's there is a mechanism both in terms of the drag to allow typically a majority of the shareholders to implement an effective sale of the entire business. So most simplistically, once 50% of the shareholders want to sell the business, they can sell the business, and they can require the minority to sell at the same price on the same terms. And the tag is the flip of that, is effectively if a majority are selling and there's going to be a change of control of the business, you have the right to require the purchaser to also buy your shares, so you can kind of tag along to the sale as well. So you're not left holding a minority stake in a business that's now under different control.
Yep, that's great. Thank you for that, Sam. So once you've got your term sheet and you've got the commercials and you've considered the terms around pre and post money valuation, that all the various dilution terms that you'll often see, the term sheet that Sam's just talked through, you'll often then get a investor who will look to carry out due diligence on the business. Different investors will have different approaches to the type and level of DD that they carry out, which largely depends on the stage of the company, the size of the investment, but generally speaking, fundraising diligence tends to cover a few main areas. Things around commercial, so product testing, market fit, technical diligence around the systems of the software, the financials, which obviously depending on the size of the business and the stage of its growth, things around the accounts, management accounts, ultimately getting an understanding of what the current burn rate is for the company and how the investment money will be spent. Tax, there's obviously, we've previously talked around certain tax incentives that might be put in place around SEIS and EIS, and option pools that may be HMRC approved and not approved, so there'll be a little bit of a light touch around that. But then also will be legal. So legal tends to cover employment contracts and incentive arrangements, the share cap and the shareholder arrangements, material contracts if there are any in place, any subsidiaries, ensuring that there's no litigation, or if there is any, getting an understanding around that, and ultimately who owns the IP. So some of the common red flags that we see during due diligence is firstly around intellectual property. This particularly kind of in certain sectors is obviously where a lot of the value of the business is. So an investor will want to ensure that the relevant provisions contained within employment contracts that ultimately state that the company is the ultimate holder of an owner of any IP. Similarly, where you're using any contractors or third parties who might be supporting, might not technically be employees, but ensuring their contractual agreements have the relevant provisions in there so that any IP that's created by them whilst they're working sits within the company. So that's one where sometimes you see things that are just done kind of on a whim and there isn't necessarily contractual agreements in place. You might often have to try and rectify that up front so that an investor will get comfortable that actually they're buying this business knowing that the IP is in the right place. Statutory registers or lack thereof, often we see that this is just one of those, people think this is kind of one of those corporate admin-y things that you just don't really look at, but ultimately these registers are important in identifying and showing who the shareholders are and whether there's been any historic transactions and if they've been regularly updated. So where you might have transfers between partners, between founders, between employees? Have they been documented correctly and properly? Is there an audit trail that shows that the shares are sitting in the right place, and you don't have a shareholder that hasn't properly signed the stock transfer shares, and actually they are still a shareholder, and how do you rectify that? So they're common issues that we often see, where perhaps kind of advice hasn't been sought on some of these transfers, and so they haven't been done properly, and it can be quite messy at times to try and rectify. Current shareholders agreement, existing instruments. So this is really where you might have kind of a seed round, decide to put in place a shareholders agreement, and not necessarily consider the terms fully, and there may be terms in there that are quite restrictive or quite onerous. So there's sometimes a challenge of, do you have the consent in order to terminate that existing agreement or to amend it, and working through any potential hurdles that might exist. So that's often one to just, as you're going through the fundraising process, is to be comfortable with the terms that you might currently have in place, because they may need to be changed, or completely replaced entirely. And the one that often causes quite a lot of issues is defective share buyback. So this share buybacks is an ability for the company to buy back shares, which ultimately kind of reduces the amount of shares in circulation and increases the share cap, by removing certain shareholders as they may be leaving the business or they no longer become employees. There are very specific requirements that are set out by the Companies Act around how share buybacks should be carried out. I won't go into too much detail around kind of boring you on those specific terms, but essentially, if it's not done properly, it becomes a defective share buyback, and that share buyback won't have taken place. So again, in order to rectify those, it can be quite tricky at times, and an investor will want to have the comfort that things have been done properly, and remedied as much as possible in advance of them making their investment. So separate to all of that, you might often find investors as well looking to carry out diligence on the founders and the senior employees. So when Johnny was talking earlier around backing the jockey, not only the horse, getting comfortable around the management team and ensuring that they are the right fit, not criminals. Yeah, not criminals. They're not going to take your money and run away and do something fraudulent, because they are looking to partner with them for a period of time. So they need to ensure that they're comfortable on that. Similarly, they may also look to get customer references on the company's products or services. So don't be alarmed if a investor says, well, actually, we want to speak to some of your customers and get some feedback from them on how they're using the service. So with all that in mind, any significant issues that are highlighted during diligence, there's often a couple of ways of rectifying it. If they are rectifiable and they are, there's ability to remedy, you can either do them pre-completion, and it might be a condition precedent in the term sheet that the statutory registers, for example, are corrected, or certain IP assignment agreements are entered into by any third-party consultant, and deal with that pre-completion if it is something material. Alternatively, post-investment, there might be an undertaking from the company and management that they will look to address some of these issues that might be less material to the investment but are still important in the long run, in terms of ensuring that they are fixed and put in the relevant agreements are kind of put in place. So that is DD. We'll transition slightly to some of the dynamics between a lead investor and any follow-on investors. So as you're going through the fundraising cycle, you may encounter certain questions as, once you've spoken to a few people of, we really like your business, but actually we're waiting for you to find a lead investor, is quite a common term. So what does this mean in practice? Ultimately, certain investors, one, they're either may not be set up to lead an investment, or alternatively, they would just like a marquee investor to come in and put some more skin in the game and take a lead in setting the price and the terms for the round. So you might have a lead investor come and say, we're willing to make a 2 million investment at a 10 million post-money valuation, but actually we only want to be 1.4 million of that allocation, and we want you to find another 600,000 from additional strategic investors who might be able to support you along the growth journey. And also, you'll often have a lead investor who will take a board seat, and some of these follow-on investors may not want to take that board seat or be involved in the stewardship of the business as it continues to grow. Separate to that, some of the follow-on investors won't necessarily want to put more skin in the game, so they'll ask a lead investor to carry out all the diligence, review the legal documents, and they will follow on with their investment based on the terms that's agreed between the lead investor and the founders. Typically as well, we don't generally see follow-on investors involved in the day-to-day stewardship of the business in terms of the conversations that are had with founders, attending board meetings. But that's not to say that they don't have their own value in their own way, because you may have a follow-on investor that may take the lead in future fundraising rounds, or they may be advantageous in terms of certain strategic partnerships. The one thing to probably bear in mind is, as you're going through the fundraising round, is one, the impact on your share cap in terms of how much equity you're giving on each round and how that's diluting you as founders. But also, once you have a large number of shareholders on the cap table, and if you start getting into the complexities of various share rights for each different type of shareholder, it can start to create certain issues in terms of how the business is run, particularly if you have different share classes or share groups that don't necessarily agree with each other. So it's definitely something to bear in mind as you're taking on further investment and you've got different share groups involved within the business. So that is a very quick canter through of kind of hopefully started off with what an investor will look at, some of the commercials around pre and post money valuation, the key terms that often arise during a fundraising, and ultimately some of the considerations around diligence and taking on follow-on investment. We thought we'd touch on first for a couple of minutes is how we work with founders and businesses, both on the investment side and also on the founder side within EY, and how we utilize our concept of fast growth platform. So we have a platform that focuses on fast growth businesses and helping them through their journey as they go through various touch points, whether that's taking on fundraising, whether that's commercial partnerships and arrangements, or expanding into different jurisdictions. So I won't spend too long on this because I know this is the salesy bit, which people tend to kind of roll their eyes at. But there are certain touch points where I think it is important, whether it's us or whether it's another advisor, that you have the proper support and advice being provided to you, so that you are getting one of the best terms in terms of your investment, but also how you're managing the funding once it's come in. What are you doing from a R&D tax perspective? Are you operating in the most tax efficient way? So all of these considerations become more and more relevant as you continually grow and take further funding, and there's more capital, there's more revenue in the business. So it's definitely worth thinking about the advisor that you have through each stage, because at the seed stage, obviously money is the most important thing and people don't like to spend too much money on advisors. But as you continually grow, your priorities will change and demands will change, and your the universe of funds that you might be interacting with, investors you might be interacting with, or advisors will become more sophisticated. So it's important to track that in your advice that's being given around you. And I think that largely wraps up what we wanted to talk about today. So we've got 10 minutes left in the diary. So we'd love to open up to just hear around any experiences that any of you have had fundraising, any lessons that you've learned, or just generally any questions that you might have as we've gone through this.
Thank you, Helen. And thank you also for the salesy bit. Actually, I think it's really important because as you mentioned, and that comes from the early days, it may also be a good idea to have the good advisors in place, because it's probably the best way to be credible in front of investors. It's a competitive game, so if you can show that you've secured the right advice and you know what you're doing, it's definitely reassuring investors. So it's never a bad thing to consider.
Yeah,
So,
definitely. I think it's important to, I think when you are going out to investors and you're doing your marketing round, is to how you can credentialize yourself. So if you are able to credentialize yourself by saying, actually, we've taken advice from EY or whichever other kind of advisor it might be, that definitely helps as part of the conversations.
yeah, it's definitely pretty easy to step. I can't see any questions. Good feedback, thank you. I have one, and maybe a tricky one, but I'm just curious. Would you recommend, I don't know, a pattern, or is there a good practice in terms of this share groups repartition for early stage companies? Often this is what you hear from them, they're small team, and at the same time they're trying to raise money with different investors because they can't find just a leading one, and they also want to hire good employees, so they need to incentivize that because they can't compete with large organizations. So you think about shares as good incentives, but then you get lost into these different share groups. And so I don't know, do you see patterns emerging from early stage companies, or if no patterns, really the advice of what not to do?
Johnny, this might be a good one for you.
I've got a view on
What's
that. One kind of headline. I at an early stage, I would typically advise avoiding putting actual shares in the hands of employees. Rather, if you're looking to incentivize a larger pool of people, I mean, by all means, put some shares in some very, very key senior staff, perhaps, but use options rather than putting equity in the hands of employees. The scenario where employees leave and are looking to get that equity back, it become quite messy and kind of leads in quite a lot of the points that Haman was talking around in terms of diligence and kind of cap table management. And you don't want to have a large shareholder base of former employees that you need to send shareholder communications to, potentially, in worst case scenario, start to have to get active decisions or approvals from, if you can avoid it. So if you are looking to incentivize employees, I think you can simplify it by just granting options over shares that are triggered, an exit only option. So the value really is if the employee is still employed and has an outstanding option at the time of an exit event, and that way it kind of keeps your cap table a lot simpler, but also incentivize employees to get to that exit event.
Thanks, that's really good
I don't know if
advice.
Johnny had any additional thoughts.
No, good advice, I think. When it comes to actually thinking about who would be investing in the company, we talked a little bit about kind of having lead investors versus some sort of group or consortium investing. In my mind, you should be targeting a kind of lead investor. That's the easiest conversation to have. And what you'll often find is that lead investor will have other VCs that they've invested with before. And so it's kind of, if you get one person to say yes, that one person can bring in 2 or 3 others that may have different skill sets and can fill out the rest of the funding round. If you're trying to negotiate with 3, 4, 5 different investors at once, that becomes very complex. It's kind of easier to do that one-on-one with a lead investor, and let them worry about filling out the rest of the round.
Mm-hmm.
Thank you, John. Can see a question in the chat box. How do investors approach valuation of an early stage company? You have another hour?
Yeah, very difficult is the short answer. Look, once a company reaches a certain level of scale and is generating revenue and is generating hopefully profit, but maybe losses at the earlier stage, there are more kind of quantitative methods for valuing a company. So in my world of software, you would typically apply a revenue multiple to a company's kind of recurring revenue base, and that would give you a valuation. At an early stage, it is much more difficult, is the short answer. And so investors come to value, ultimately they're taking on risk, and so they're viewing value in that risk framework, and they're thinking about lots of the topics we talked about, right? Quality of the team is really a key one. And then quality of the product, have you proven product market fit? And then they will look at comparable deals, fundraising rounds that have happened in your sector, and use those as a benchmark for where they think valuation should be. Ultimately, it's competitive tension, I think, in these early stage fundraising rounds is the primary driver of value. If you have 3 or 4 people at the table all wanting to invest, that's the kind of easiest way forward to actually move up valuation. Anything to add there, Sam or Hamam? You see a few more of these very early stage fundraising rounds than I do.
Not really. I think you've captured it. It is kind of having a pretty good story, convincing story as to the growth of the business and kind of what the addressable market is, and kind of being able to show a route to scalability is quite important and a good value driver. But I think you've kind of captured the difficulties at an early stage of kind of being too prescriptive around kind of, or formulate around what and valuation would be.
Yeah, particularly because you don't, I guess, of challenges, as you both alluded to, you just don't have the metrics at that stage. So that traditional route doesn't necessarily apply. So I think that narrative in the story, I think, is really important. So whenever you are having these conversations, nailing down your story and getting someone to buy into that, I think, is where the value comes from. But ultimately, the size of the check that's being written at a very, very early stage is largely, I think, speculative on the potential future gains that might potentially be arising, or the opportunity that exists.
Thank you. And if I may add, a tiny advice is definitely collecting as much data as possible. And if I put that back into the context of therapeutics, life sciences, early stage, you have this additional layer of bringing information about market access and what are different routes of potential reimbursements, etc., which are definitely driving the value to that. I can see another question. What impact is the NSA Act having on early stage financing in life sciences, and how are investors, funders approaching any impact on the act?
Good question. I think, as with any newly, and I assume people know what the NSA Act is. It's effectively a range of particularly kind of sensitive areas that, to national security potentially, where there is a notification requirement to the government, and there's a little bit of analysis that needs to be done around whether or not you fall into that criteria and whether there's a notification requirement or any approvals needed. It's relatively new. I think, as with anything that comes in that's quite new, the majority of investments we see, people are taking quite a conservative approach in terms of whether they need to make the notification or not. It's not having, so as far as I've seen from my own personal experience, having a significant impact on kind of valuations or the process. It's just, so far it has been a kind of just an additional diligence item. It's very much, from an investor's perspective, it's almost a self-certification for the founders of the business or the people involved in the business to make, as to whether or not they think they fall within the criteria. So we quickly approach it by asking kind of a host of questions that are kind of designed to drill down into the specifics of the business and whether or not they would fall into the various categories. But we haven't seen, certainly in the majority of investments, you often are not seeing investors take a controlling stake, so above the 25% stake that kind of triggers the notification requirement, or having sufficient control outside of that 25% to warrant a notification. So in short, I haven't seen a significant impact other than kind of people making sure that they're not falling foul of it and being the first investment to kind of get publicly knuckle wrapped.
Yeah, and just kind of for the broader group, for anyone that's not familiar, certain sectors, life sciences being one of them, and specific branches within that that are protected in terms of investments or transactions within that space. And if a transaction falls within one of these protected sectors, then you have to make a notification, as Sam was, the government. I had actually a transaction recently. It wasn't an early stage, it was slightly more advanced than that, but it was around synthetic biology. I think some of the issues that we had is that there just isn't any precedent at the moment, because it is new legislation, in terms of understanding whether this would fall within a particular category. So a lot of it was a judgment call. So there was work between the company and the buyer as to what the business actually does and whether it falls within some of the guidance that has been provided. The guidance is helpful, but as you say, if you don't have a precedent, it becomes quite difficult to know whether or not you fall within that criteria. But did take a conservative approach and made a preliminary notification in any event, just so that they didn't want to file other regulations. So I think that is the general route that is being taken, is that people are acting more conservatively whilst it's new, until we have an established way of working around it.
Okay, thank you. Hope that answers the question. Looking at the clock, and it's 12, so I suspect everyone has other meetings to go to. So I think I'm gonna wrap up here. Thank you to all attending. I hope it was useful to you, and thank you very much for presenting this introduction to, well, to Investor 101, explaining lots of the key jargon and term sheets element. I think that was really useful. It was for me, so I hope it was for the rest. As I said, this was recorded, so I will circulate a link as soon as I have it on my computer. And thank you very much again for attending. And if you have any question, speakers and Ruby from UI, who was also on the call today, they're very happy to get back to you if you would like to take that privately. And I will make the connection if useful. So thanks very much, and have a good rest of your day.
Thank you.
Thank you.
Thank you.